Welcome to the Silicon Valley Podcast with your host, Sean Flynn, who interviews famous entrepreneurs, venture capitalists, and leaders in tech. Learn their secrets and see tomorrow's world today.
Nathan, thank you for taking the time today to be on the Silicon Valley Podcast. Now, I'm super excited for this. We've been planning to do this interview now for a couple months, and it's finally happening. You've just come back from an in-person conference. We won't go into names. Maybe we'll mention it later. But I've been really excited for this interview. But I know your background. Could you tell our audience a little bit about it?
Sure. Thanks for having me, Sean. Appreciate it. Super excited to be here. So my background, right now I run Foundersuite, which is a software platform for raising capital. But before that, I spent some time helping companies raise capital. I started my career doing investment banking. This is years ago during the dot-com bubble boom, and then went off and hung out my own shingle company here called Venture Archetypes, helping companies raise capital, then decided to build a software platform for raising capital. So kind of my entire career has been working with startups, helping them raise money. And, that's what I really love doing. So kind of fun to come on here and talk about raising capital.
Okay. So you've been in that space your whole career. A lot of it, I'm guessing, here in Silicon Valley. Now, when I talk to people that aren't from Silicon Valley, what they tell me is, I visualize Silicon Valley as I get up on a plane, I arrive in San Francisco airport, I get off the plane, I check, I get my baggage at checkout, and then I have a check in my hand for my startup. Then I don't even leave the airport. I just circle back, get back on my plane, and go home. How realistic is this vision of just everyone handing out money to startups here?
Yeah, you can't swing a cat without hitting a VC here and, they're just dripping money. No, of course, that's not true. There's a lot of money in Silicon Valley, right? It is still, even with kind of the dispersion that's happened with COVID and everything, it's still the epicenter of venture capital, far and away, number 2 and number 3 in terms of how much money is deployed here. But it's still very hard to raise capital, right? I've known startups who have done something similar to what you just described, where they kind of jet in, meet a bunch of investors, walk away with a term sheet or a check. But that's extremely rare. And all of those did a lot of legwork and prep work before landing at SFO, to kind of grease the wheels and get investors teed up. So you're not going to just come here and walk away with a check on Monday, jet in on a Friday and walk away with a check on Monday, unless you've spent 6 to 12 months kind of building relationships, getting the traction necessary, to excite investors and everything else. So.
Okay. So it sounds like it's not as easy as people think, but I mean, how hard is it? What should people expect in a fundraising process? What should they expect, kind of timeline, kind of difficulty? Like, what would be a more realistic idea of the situation?
Yeah. So let's talk about timeline. I mean, most fundraisers, from my experience, take from 2 to 6, sometimes 2 to 8 months. 2 months, you're going very fast. That's a really fast fundraise.
Is that 2 months if they have their pitch deck and everything solid already done, or is that just a general outline 2 to 8 months?
Yeah, I mean, that's a good question. So 2 months, assuming your materials are in place and you're ready. 2 months, I would say, kind of from the day you start talking to investors and start pitching investors and start your outreach process. That's really fast. But I know startups who have done that. They usually have some outlier attribute to them, like insane traction, momentum. They're blowing up on Product Hunt or Discord or something, right? There's something happening to them. Investors are often coming to them because the company is just growing so crazy. I also know founders, like, let's take this apart a little bit. Like, why do some startups, why can they raise in 2 months? Another reason is the founder's done a really good job of identifying, the 100 or 200 ideal fit investors for them. They've possibly reached out and nurtured those relationships or got the intros in advance. And then they say, all right, we're starting our fundraise, April 1st, and we're going to run it for 8 weeks. I'm going to run intro meetings for these first 2 weeks. Everyone who's interested, right? They have a very discrete timeline. Intro meetings for the first 2 weeks. second and third round meetings, for a week or two after that. Diligence for the following week. They have their data room all set up, ready for diligence. So that's not a delaying factor. And the founder's able to dedicate his or her full time to fundraising. That's what makes a fundraising goes really fast, right? Identifying the right investors, having all your materials ready, and just running a really tight process and packing your schedule full of meetings. And, kind of interestingly, during COVID days, I've known founders, and we've had them on our podcast, that have used the Zoom pitch meeting to pack in 10 pitch meetings a day instead of the 5 or 4 pitch meetings you can do if you're doing it face to face, right? So they've been able to compress the time frame a little bit. Let's just take that the other end of the spectrum. If your fundraising is taking 6 to 8 months, why is that? It could mean almost the inverse of everything I just described. Maybe your traction isn't so incredibly dramatic that investors are just chomping at the bit to get into your deal. Maybe you weren't quite prepared for diligence, so you've got to kind of gather these materials. That can take some time. Maybe you're just too busy dealing with customers and partners that you can't devote your full time to fundraising, and that's all these things can make the fundraising take a little longer. So,
okay. Yeah. So with that, the due diligence part, and I guess we can go into a lot more detail later of all those different parts and break it down and what a time frame might look like and things that go in the data room or the pitch deck, all that stuff. But how come such a small percentage of companies actually raise funding? Because it sounds like, well, there's this process that people go through, and if you just follow this process, that end result should be that check. Why even do people just not know this process, or why is there such a small percentage that actually gets some funding?
Yeah, I think that's not everyone knows that. I don't know the exact statistic, but it's single to low double digits of what companies go out to raise money actually raise money, right? 5 to 10% is probably a reasonable benchmark. I don't know if anyone tracks that exactly, but
is that 5 to 10% you think for their next round or to get to that exit?
For the next round, yeah. I think I've heard statistics that only 5 to 10% of companies that try and raise money are successful in raising money, and so there's another misconception that it's easy to raise money, right? It's actually very, very hard. So of the 90% that aren't able to raise money, why can't they? Again, it's a lot of those factors I mentioned. Maybe their traction is not very good. Maybe their pitch is not very good. I would say, top 5 reasons why startups fail at raising money is, number 1, their pitch is bad. It's actually quite hard, I feel, to do your own pitch and to build a good pitch when it's your own story. Founders often want to pack in the entire story, their entire journey thus far, where that's really not what investors need. They need something crisp and light and, high level. I would say founders don't do a good enough job targeting the right investors. They spray and pray, and that can actually hurt you if it feels like, even if a relevant investor feels like you didn't do any research on them, that you're just kind of, reaching out to 1,000 investors coldly, that can turn them off, right? So not doing the targeting, and, not having the right traction. When I raised money for Foundersuite, I had tried 2 other times. I tried once, didn't get much interest from investors, took a break, spent 6 months working on the product, went back again, tried again, didn't get much traction again with investors, took another break, got my momentum and traction up again, and then 3rd time's the charm, is able to raise money. But that's pretty common, right? Investors will say, hey, you're too early. I like what you're doing, but you're just a little too early for us. Come back when you have proof of concept, market validation, revenue, whatever that may be. So
that's interesting. The fact that you said it took 3 times going out to the market to actually get that check. Do most companies, would you say, kind of give up on that process after maybe the first failure, the second failure? Or, is there one thing that really stands out? You mentioned 5, but one that really stands out from that person that starts to go out to that person or company that gets that check?
Yeah, I think, we have close to, I'd say, 3,000 companies on our platform using our software to raise capital. So I talk to a lot of these founders, and I'll get people coming to me like, hey, I need to cancel. I'm just not having any luck on fundraising. I'll say, Okay, well, let's just unpack this a little bit. How many investors have you talked to? You're like, yeah, I talked to 20 investors and no one's biting. Like 20's, you've barely scratched the surface, right? That's the tip of the iceberg. So kind of segueing this a little bit, I mean, fundraising is oftentimes a numbers game. You have to talk to a lot of investors to find the believers, as I like to say, right? The ones who are already kind of thinking about your industry. Maybe they're thinking about your industry in the similar way you're thinking about it, right? The ones that just kind of have a natural organic match to what you're doing. So I do think you see a lot of founders that give up either prematurely because they haven't talked to enough investors. I think that's pretty common. So
I liked how you said, they talked to 20 and they gave up. And I've had that conversation so many times with founders, and the investment bank I'm at, they're like, well, how many potential buyers are you going to go out for our company? 10, 15. I'm like, no, we're going out to, 1,500 that their investment thesis fits your company, sector, state, like everything. And they're like, what? Like they can't understand what the pipeline, that funnel looks like from this huge down to that, that one you decide to go the dance with.
Yeah. I love this. Anyway, I do a talk called Funding Hacks, and we use a funnel, metaphor for this, kind of thinking about what the top of your funnel looks like in each stage, and kind of broadly speaking with a lot of startups. And I even use our example. That third time when I actually ended up raising capital for Foundersuite, I pitched over 200 investors and ended up with 1 seed venture fund and 10 angels coming in on the deal. So that's about a 5% conversion rate between who I pitched and who wrote me a check, right? And, had drop off at each stage of the funnel. And that's pretty common, I think. I've seen that kind of 5 to 6% conversion rate come up time and time again with other startups. So that's just sort of goes to show why it really is a numbers game. You've got to talk to a lot of investors to find those 5% that like you.
So we talked about, the funnel, and that funnel could be the entire process. Mm-hmm. Can we go a little bit deeper into each of those steps of that funnel, each of those steps in the process, and kind of lay it out and break it down?
Yeah. So top of the funnel, where you're, maybe building a list of 200 to 300 potential investors. That's kind of your broadest part of the funnel, right? And then, I would say sort of step 2 beyond that is to really qualify that list, right? Go in and do a little more research. As a general rule of thumb, I say maybe spend 10, 15, 20 more minutes per each investor at the top of the funnel, and just make sure they invest in your sector, your stage. That ideally you identify that they've raised a new fund in the last couple of years, right? So they're actively investing.
Well, why would that be important?
Well, if you're not intimately familiar with how venture capital works, a venture firm will raise a new fund, call it a $50 million fund, and then they'll put half of that to work, investing in a bunch of companies, and then they will, over the first, say, 2 to 3 years of that fund, and then they will save the other 50% of that fund to double down on their winners. And so if you're, looking at a fund that hasn't raised a new fund in the last couple of years, they might just be, saving their fund to do the follow-on deals. They might not be doing a lot of new deals. And conversely, the best fund to be pitching is one that just raised a new fund, right? They've got fresh capital to work. They're looking for a new cohort of deals to invest in. So, even when I was raising money, I talked to a lot of funds, and the meetings can be productive. The meetings can be good, but when you get into the meeting, you're like, so you guys actively investing? And they're like, well, we're actually raising our next fund right now. I'm like, okay, well, I'm not going to get a check from you. Still nice to meet you. Maybe this will come to fruition for my next round, but it's easy to waste a lot of time pitching funds that don't have like dry capital to put to work. So that's it, so kind of thinking that large funnel. And then the next step is qualifying that list. Like I said, making sure they invest in your type of deal, making sure they don't have a competitive deal in their portfolio, right? It doesn't really make sense to be talking to a fund that already backed a competitor. It's not likely they will invest in you. They might even share your deck with your competitor. I've seen that happen many, many times. And, and then kind of the ones that drop out from that stage, I'd like to say, expect to remove about 30% of that initial list. Then the next stage is let's try and find a mutual connection, right? If you have any advisors, mentors, previous investors, maybe you raised some angel money and your angels can connect you, kind of tapping your overall social graph to see if you have any connections, looking on LinkedIn, obviously. And then if you don't, how do you build those connections? We can talk about that in more detail, but you're basically kind of trying to find the right funds, the right people at those funds, find the right path to those people. And then it gets into the really fundraising process of getting those intros, the pitches, and we can go into that if you want.
Oh, definitely let's go into that. But I also want to say I've talked to so many founders in that had no idea how strong their networks were.
Mm-hmm.
And you'll talk to them. I remember one time I was talking to two co-founders, and one of them had gotten, I think it was a PhD at MIT, and the other a master's at Stanford, and they were saying, we don't know any angels.
Uh-huh.
And I was like, each of your universities has its own angel alumni network.
Right.
Each of your universities have all these people in your space that have founded these huge public companies.
Totally.
How can you not tap it? And then we started talking and they're like, oh, actually, yeah, I guess we do have this strong network we could leverage. We never thought about it.
Yeah. Well, even I'll drill on that for a minute. Even just going into your LinkedIn, searching in the search bar up in the kind of upper left for angel investor, and then applying a filter of like first or second degree connections will show you. And then you can go even further. Let's take that example, right? Search on angel investor, search on first and second degree connections, and then put in your university, right? That will show you all the angel investors that you have some connection path to that went to MIT as well. And, how you can reach them because you have a mutual connection. Like your network's probably larger than you think. And a lot of people don't kind of know how to activate it, right? But you've also got to be hustling. I mean, I know other founders that kind of back to your original question, they'll drop into Silicon Valley, spend a couple weeks here, and they just hustle like crazy. We had one on our podcast, this guy, Australian guy, and he kind of tapped the Australian connections. He kind of made a list of every Australian founder out there, told him he was coming to Silicon Valley, reached out to them, got coffee with them, told him what he was doing, right? And just kind of worked this network based on the commonality of being originally born in Australia, right? And you can do that same approach using your university or many other factors. So, yeah.
All right. So go on. So you're reaching out, you're connecting with everyone on LinkedIn, you're tapping your advisors, your mentors, everyone. What's next?
Yeah. So, I kind of think of this almost in the preparation phase and then the go time phase, right? And in the preparation phase, I would still be kind of mapping those connection paths, like we just talked about, and even reaching out to other founders who may, like if you have identified an investor, for example, that is a dream investor for you, but none of your advisors know her. You don't have any, second degree connections on LinkedIn to that person. Looking at her portfolio companies, even reaching out cold to a couple of the founders that she's invested in, getting a dialogue going with those founders, maybe if they're local and in Bay Area, taking them out for a lunch or something like that, just asking for some feedback on your deck. It doesn't have to be a hard sell, but trying to build a connection path if you can't find one, right? And so I consider that still in the preparation phase. Also in the preparation phase, I would say just making sure your deck, your pitch deck, your financial model, ideally setting up a data room, which has all your sensitive documents in it that investors are going to want to see, getting all those ducks in a row.
Can you dive a little bit more into that? Because almost every conversation I have, people don't know what a data room is.
Yeah. Yeah. It's kind of funny because I think they are used much more in investment banking and M&A deals and later stage deals, but it's equally applicable to early stage rounds. And not to make this a product plug, but we just launched a data room within Foundersuite. It's like a month or two old, so it's a brand new product. It's really awesome. People are really using it.
Well, before even going further, give us a 60-second overview of Foundersuite, because we keep referencing it. So maybe, just plug it right now.
Okay, here's a quick plug, shameless, but it's a whole suite of software platforms for raising capital. We have a database of investors to do your hunting and searching, to build a target list, about 200,000 investors in there. Angels, VCs, corporate VC, family offices, kind of everything. We have a CRM to help manage the whole process, where you're at with every investor. We have a pitch deck hosting tool, put up your deck, send it out, track who views it. We have investor update tools to send out like a quarterly or monthly update about your business. We have an email tool for doing like follow-up at scale. We have a collection of documents like term sheets, pitch decks, cap tables, stuff like that. And we have a data room, which is really useful for running due diligence. And so I'll segue off on that. But yeah, due diligence, comes a little bit later, like when we're talking about the process, but it's good to prepare for it early on. And so what I recommend is, setting up a data room, having folder structures like corporate documents where you're putting in, basic stuff like articles of incorporation and all that good stuff. Having financials, right? This is where you're putting historical financials, your financial forecast, things like that. Maybe a folder called intellectual property, where if you have any patents or anything like that, put it in there. Product roadmap could be another folder talking about kind of, where this is going. Customer references and also customer pipeline, that is often another folder that I see people have. Marketing plan, which is maybe just a collection of any press and marketing activities, including like your metrics and stuff like that, right? And team and advisors. So you can kind of have a whole structure of folders there, and then you populate this with all the files that are relevant to each category. I'll give you an example. When I was raising money, I got a term sheet from FFBC in New York, great little seed venture fund in New York. And I got the term sheet on Friday. I was super excited. And then on Monday, they sent me their due diligence list, which was like 140 items they needed. Everything from customer references to personal references. They wanted access to my Google Analytics. They wanted all our, financial documents and stuff like that. And I wasn't really ready for it. Like I had some of that stuff collected, but getting all that stuff in order and having it in a neat, orderly format that you can then send to investors when they ask for it will make everything go really fast, much faster and smoother. It also shows you're really prepared, right? You're not an amateur at this. If an investor says, I'm interested, can you send me your financial documents? And 20 minutes after that meeting, they get a link that invites them into the financials folder in your diligence room. You look like a stud, right? I mean, it can make you really look good. And the cool thing about, a data room is you can kind of set access on who can access what documents. Can they view it only? Can they view it and download it? Can they view it and print it, right? There's a lot of control you have over it. So anyway, I digress about the value of a data room in general, but that would be kind of the prep phase, right? Finishing up your pitch deck, your model, getting your data room all ready.
Would you recommend working on the data room before doing your pitch deck and everything, or simultaneously, or after? Because I've noticed, at least for me, if we get the data room first, they think about that pitch deck. They think about the whole company while they're moving forward, creating the other marketing materials. But what's been your experience?
That's a great question. I've never really thought about it. When I've done this in the past and when I used to work with clients, we would often start with the pitch deck only because getting the story, the pitch deck is all about story, like building a story. And that's kind of the starting point for me when I think about it. Like, what is the story we're going to present to the world, to investors? So I usually start with the story, and then how do we tell that story in numbers? So that's where we get into the financial model and stuff like that. So I think I would probably do the data room last, but I totally see the argument of starting it up front. So you're thinking about your business, as a whole entity. Yeah, I've never really thought about that. That's a good question.
All right, keep going with the process.
So wrapping that up, everything from kind of recapping, building that target list of investors, qualifying that list, mapping connection paths, getting that all loaded up into a CRM or some system, for managing it. Because if you're going to be talking to a couple hundred investors, I really believe you need some system of tracking it. Maybe it's a CRM like Foundersuite. Maybe you're using Salesforce because you're already familiar with Salesforce. Maybe you're using a spreadsheet. I don't really recommend a spreadsheet, only because it becomes pretty messy pretty quickly when you're talking to a couple hundred investors. It's hard to really make it actionable, but people have raised money using spreadsheets, and so that's all prep phase. And now, the next phase is kind of the execution phase, really the hustle phase, as I like to say also. You've got everything ready. And now, you flip a switch and say, all right, April 1st, we're starting our fundraise. And that's where you start to ask all your connectors for that intro, pretty much all around the same time frame, right? You're really trying to get a lot of momentum going. And here's maybe where, if you're not in Silicon Valley, where you start to schedule a week or two here, and you ask your connectors like, hey, I'm going to be out in Silicon Valley. Can you connect me to Martha at Benchmark Capital or whatever? You try and start to pack your schedule full of meetings, leaning on your connectors to make those intros. And here the key is really, a couple things. One is getting momentum going, having a lot of meetings in a pretty dense time frame. We call this calendar density, right? Really getting a lot packed in, and just having that sense of momentum that investors can kind of pick up on when you're meeting. If I'm sitting down pitching you, and I can kind of signal that I've got 6 other meetings after you. If you're interested in my deal, you probably are going to pay attention, and you might be moving a little faster, which is what we all want.
Now, how can a founder, or should a founder, prep in advance for these meetings? Should they have their friend ask them a bunch of random questions? Should they have their advisors or mentor quiz them? How should you prep? Because I would guess you don't want those first 3 meetings to be your trial meetings.
I love this question. I should have included that in the prep phase, right? Because yes, I kind of skipped that part. You shouldn't go out, especially with your top funds, having not given your pitch. I like to tell founders, make sure you give your pitch at least 10 times to people who will give you honest feedback. That could be attorneys, your accountant. It could be guys like you, maybe that are, do in the investment banking world and see a lot of deals, maybe. And I don't want to speak for your business, but maybe, the startup's a little bit premature for your business now, but could be a client down the road. Maybe you'd be willing to give them a quick 20-minute, feedback on their deck or something like that, right? There are people who are in the industry who will give you feedback. Also leaning on other founders, right? If you're in an incubator, an accelerator, or even a co-working space, tap a few folks to sit through your pitch and give you honest feedback. You want honest feedback. You really want people to rip you apart as much as you can. And even reaching out, combining a couple of the prep phase things. Let me try and make this as clear as possible. Let's say you identified Martha at Benchmark as someone you really want to get to know. So you reach out to a couple of her portfolio company founders. Reach out to them simply asking, hey, I'm going to start fundraising. We're in the same kind of general space. We're both doing, e-commerce, software, or something like that. Could you give me 10 minutes and give me feedback on my deck, right? Reaching out to those company founders who've been funded already, they're going to be a gold mine of feedback on your deck. So, and those could also lead to those introductions, to the investor you want. So you're kind of getting 2 birds with 1 stone there.
Well, I think you also might have missed something that Foundersuite, shameless plug, gives. Don't you also kind of give hints of what maybe VCs kind of like, or feedback from people that have gone through meetings with them? And if these portfolio companies, if you're getting hints from them, they might give you hints of, hey, that VC really likes it when you cover this, or go really deep dive into this, part or that. Just wondering, is that?
Yeah. So we just launched something that we're calling Investor Insights, and it's we're trying to tap that kind of wisdom of the crowd. So if you just pitched Martha at Benchmark. I don't think there is actually Martha at Benchmark, but
there could be one person right now, like just looking around going like, what
who the hell are they talking about?
My inbox is so full now. What's going on?
So if what we're trying to do, and this is just a few weeks old, actually, the ink is, or the paint's barely dry on this, but it's called Investor Insights. So we're trying to tap our actual customers. We've got a couple thousand startups using our platform. So if you just pitched Bill Gurley at Benchmark Capital, that's a real person, and he was just drilling on product, we want to kind of glean that information from you so that the next person to go in and talk to Benchmark knows, oh, Benchmark is really product focused, or this other VC is really numbers. They're just going to drill into your numbers, so go in prepared. Really kind of helping you, better prepare and bring a little more transparency, and kind of founders helping other founders along this journey, which is always painful. So yeah, that's a new thing we're working on.
I love being able to focus and tailor your pitch per whoever you're sitting across from. So that's fantastic. Okay, so you're now, I guess we're at the stage where you're getting the meetings, or Are we still getting the warm intros?
Well, yes, both. The warm intros, hopefully those intros are leading to meetings, right? And kind of something I think I would recommend is possibly staggering those intros and meetings a little bit, maybe to put some of your sort of second tier investors as your first meetings, just to get a few more reps and practice on your pitch deck. That's a pretty good strategy, right? If your dream firm is Bill Gurley or dream investor is Bill Gurley at Benchmark, don't pitch him the very first pitch, right? Make sure you've given a few reps to real investors, before stacking your dream team. And really, like I said, trying to pack your calendar full of meetings. So you're having 3 to, I know founders who have done 10 meetings a day in the Zoom era, with investors, really packing your days full of pitch meetings, and you're trying to get, like I said, momentum going. Investors will often ask you in a pitch meeting, so how's the round coming together? Where are you at with this round? And you want to be able to answer with signals to them like, hey, it's coming together pretty good. We just started this round April 1st. I've got, 14 meetings lined up this week. I've got 20 next week. It's going to be a crazy week next week. I'm trying to get all my first round meetings going with my target list in these first 2 weeks, and then do partner meetings, weeks 3 and 4, and then, really get term sheets in by week number 6 or initial indications of interest. You're setting a timeline right there, and you're signaling to these investors that you're running a pretty tight process and that you have a lot of other investors interested. And that all that combined can really help drive a pretty quick fundraise, which is what we all want, right? That way you can get back to building your business. So
I like how the whole process was always starting on April 1st. I think if I were to do that, half the people I know are like, Sean, is this a fool's joke?
Yeah, exactly.
Like,
maybe
what's going on here?
April 2nd, right.
So of that whole process, where do, and maybe I've already drilled down on it, but where do people try to skip? Or where do they have problems with? Where are they just like, yeah, I'm just going to go from A to Z and forget this in the middle?
Founders do skip that qualifying the investor list part a lot, right? It's not, contrast this to 10, 15 years ago, or it's actually hard to find investors. It's not that hard to find investors anymore, right? You have databases like Foundersuite, like Crunchbase, like PitchBook, Signal, which is a venture fund, has a database of investors, right? There's multiple online databases of investors. So it's not that hard to find kind of a starting list of investors. But then where people do skip is they don't qualify that list. And so they're reaching out to a fund that might do their sector, B2B software or fintech or something, but they're later stage fund, right? And you're a seed stage deal. It doesn't make any sense to reach out to like a growth fund, right? If you're raising a seed round. And the investors like, this guy clearly didn't do the homework on me. The more you can tailor, your outreach, your pitch, your whole messaging around each investor, that you really know what they're doing. Maybe you followed them on Twitter. Maybe you can reference some other deal they did, right? This all goes to show that you've done your homework and that you're really reaching out to them. And then it's a fit. Investors usually will welcome that outreach, even if you do cold, which I don't know, that's another topic. But even if you've done cold, but you clearly show that you understand this investor's thesis, they're often welcoming to that because there's a match there, right? So that's where I see people skip a lot.
It sounds like this whole process is kind of very similar to selling a product.
Mm-hmm.
Are sales skills very, very important? I mean, if you don't have those skills, is it hopeless? What should people be focusing on maybe to grow and develop to give them the best opportunity throughout this?
Yeah, it's a great question. A lot of founders, a lot of startups might be run by technical founders. That's actually very attractive to many investors. They like to see like technical founders, especially at the early stages. But a lot of times, technical founders aren't necessarily good salespeople. Maybe they're introverted. Maybe they're just kind of don't have great people skills, whatever it may be. So, being able to sell and to hustle in a positive way is a good thing. I think pretty important. One of the things I tell founders sometimes, like when I'm doing our podcast, is you've got to channel your inner hustler. Even if you aren't a natural extrovert or a natural hustler, you've got to kind of, not be afraid to get out there, talk to investors, get on a Zoom, get in a face-to-face meeting with them, bring the energy to those meetings, get them excited about what you're doing, and ultimately ask for the next step. The next step could be another meeting, could be to, get them into your data room. It could be starting to talk about terms. It could be simply asking them, are you interested in this deal? And if so, what happens next, right? Kind of pushing things towards the next step, right? One of the kind of corny jokes I make, like the way our CRM is structured, it's like a Kanban board. You have, stages of fundraising from research, contacted, pitch, diligence, committed, said no. And then each investor is a card. And one of the stupid jokes I make is like, it's kind of like a chess game where you're moving all these pieces across the board. And you've got to be kind of actively working these pieces and moving them across your board into the next phase, right? So everyone who you've pitched, what can you do to kind of hustle and nudge them into diligence discussions, right? Everyone who's in diligence, what are they waiting on? What can you do to kind of move those people into, putting down a term sheet or otherwise, coming in on a round if you already have a lead. So long-winded way of saying, yes, I think sales and kind of quote unquote hustle skills are important. Got to keep it all moving. I think also just relationship building skills, which is sometimes different than sales. Sales can be sometimes transactional where you're just trying to get someone to say yes or no. Relationship can be something that you're nurturing over a period of time. And that's a whole nother topic we can talk about, but that's also very important too. And that can be much less salesy, more, more nurturing, if you want to call it that. Yeah.
Speaking of nurturing, during this process, they have access to your pitch deck. You've talked to them, and you're getting feedback. Yeah. Constantly getting feedback. Constantly, okay, change this, update this. Have questions. When you're changing your pitch deck, when you're updating and modifying it, how often should you send out notifications of updates to people you've talked to, or how often should you be updating this material, or is it kind of one and done, forget?
Yeah, that's a good question. So here's a somewhat controversial topic in the fundraising world, whether to send your deck, for example, your pitch deck, as a link and having that deck hosted online, like on a site like Foundersuite or DocSend or Google Slides, or whether to send your deck as an attachment, right? Because a lot of investors prefer the attachment. That way they can save it to their own CRM or whatever. They can view it on their phone, all this good stuff, right? The argument for having it online is that, like you just said, you can constantly update your materials. And when I was out fundraising, I have my starting deck, I would go out pitch, I get a lot of feedback, and you have to be selective in what feedback you take because your head will spin around if you just take it all. All right. Finding patterns in the feedback, working that into improving your deck, and then uploading or updating your online deck. And so that way the online version is always the latest and greatest. Now I don't send out a notification every time I update the deck because I'm probably updating this deck almost every day, a couple times a week at least, right? But even if you send a link to an investor 2 weeks ago, it's always pointing towards the latest and greatest version of your deck. And I think that's a really nice thing to do. So short answer is, kind of constantly be tweaking your deck, overcoming, if you can tell one of your slides is confusing to investors, maybe it's your market rollout strategy and everyone gets stuck on that or is puzzled by that, improving that, also kind of in the same category. You didn't ask this, but I'll say it anyway. If you can have someone else write down every question an investor's asking, right? Maybe you record the Zoom, maybe you have your co-founder in the room just writing down all the questions, building a bunch of appendix slides to answer those questions can really be helpful too. So bottom line, your deck should just be getting better almost every day of your fundraising process, right? And that helps. You're getting momentum going on your deal and your deck and your story is getting better. Those things to kind of reinforce each other. So,
and we've talked a lot about the view from the entrepreneur side.
Yeah.
What's happening? Because I think if people are aware of it, it'll give a lot more context of the whole process. What's happening on the investor side from the time they get an email sent to them to the time maybe they send out a term sheet?
Yeah, it's a good question. And I think it's important because founders often probably don't appreciate it, what it's like to be in the investor's seat. I would start off with most investors, especially if they've been investing for a while and having kind of brand, are getting literally hundreds of intros even per day, right? And they're seeing and talking to thousands of startups per year, right? So I'd say step one, just understand from the founder's perspective, you are one of 50 other startups that came across her email that day, right? And then if you get to the pitch meeting, hopefully it gets to the pitch meeting, you are one of 30 companies that she met with that week, right? And you hear some of the stories about how many, a certain venture firm that's pretty well known will have talked to 1,000 companies in a year. Each partner's doing, it's 3 partners, 4 partners, each partner's doing 4 deals a year. So they're investing in, call it 16 companies out of the 1,000 they talk to, right? So I guess where I'm going with this is just first understand they're just getting like a fire hose of deals coming at them. And I think a lot of investors, rightly or wrongly, are kind of they're looking for reasons to say no, right? They're looking for reasons to just cross this off. It's too early. It's not a fit. Founder didn't come in through the right channel. It's a cold email. Some people I think rule that out. So they're kind of, because of the fire hose of stuff coming at them, they're looking for reasons to say no. When something does sort of like pop out of their inbox, that looks interesting to them, okay, so let's have a meeting. I think a lot of investors will often use kind of their gut tuition, even in that first meeting, to make almost, I don't want to say this is common across all investors, but I think a lot of investors will sort of make a decision fairly quickly and then use the rest of the meeting and meetings and due diligence to either support that decision or to cross that decision off, right? So they're kind of making pretty quick decisions about, do I like the startup or not? Once they decide they do like the startup on that Zoom or that pitch meeting, they'll want to get kind of a second opinion of the other partners at the fund, right? And that's where you as the founder might come in and meet other people at the fund, possibly even at a partners meeting, which could be a room of 10 people, and you've got to present your pitch and kind of be on the Shark Tank firing line in front of a lot of other investors. They might also kick you, I don't want to say kick you down, but kick you or put you to a junior member, maybe an associate or analyst, who are going to dig in to the business a little bit more. And that's okay. That doesn't mean you're getting, handed off to a junior person. You're not getting demoted, even if you're talking to a partner, right? But you've got to kind of go through that process. And, so it's kind of like, all right, from the investor's perspective, do I like this idea? Do I like this founder? Do I get a good vibe about him or her? I'm going to have my analyst check it out. Do the numbers check out? Do their traction seem real? Can I believe these numbers they're putting forth? Okay. All the while I'm thinking, are there other investors hunting this deal? Like, is there momentum around this deal? Do I need to pursue this investor a little bit if I do kind of like this? Or can I kind of watch and wait and, build a relationship with this founder over a period of time? But hopefully there's some momentum that's pushing you as the investor to kind of move quickly. So then that's where you might ask for your, you start talking about valuation and terms. Like, here's how we wanted to do a price round. You start to get into that, and then you get into due diligence and again, kind of do even a deeper dive into all the data and stuff like that. And, so it's almost a reverse funnel on the investor side where they're talking to 1,000 companies to getting down to their 10 or 15 that they're looking to do. So, right. Does that make sense?
Yeah, actually that was really good. And we also talked, and I was thinking that right now of what else we didn't cover that needs to be prepared in advance before the whole process. Documents, pitch deck 1, NDA, is that important? Or what documents are needed that you should have prepared or ready before going out?
Yeah, most investors won't sign an NDA, and I think it can hurt you a little bit as a founder if you're asking investors to sign an NDA, because most won't. And so then you've got a point of friction already. I think you should almost have a set of materials like your pitch deck, even a high-level model that you can share with investors that don't have all your secret sauce in it, right? And then you put your really sensitive stuff like intellectual property in a data room, and then you can track which investors are looking at that. I would say to answer the question, like, what else should you prepare? I would go off on a little bit of a tangent here. One of the things I like to tell founders to do is to actually build relationships and nurture relationships with investors even several months in advance. And that can be by using company updates to kind of nurture these relationships with investors, right? So, in a perfect world, you as a founder want to raise money in September, right? Maybe you start building this target list of investors, reaching out to these investors with what I call the permission email. Now, call it April. And the permission email is like, hey, Sean, I see you've invested in these companies. You've done a lot of activity in our space, which is SaaS. I'm launching a new startup called Foundersuite, doing SaaS, fintech. We just launched a few months ago. I'm not raising money right now, but I plan to be this fall. We're going to kick off our seed round. Can I have your permission to add you to our update list? We send out a monthly update. One page just talks about our progress. I would love to give you an early peek at what we're building. And, you start to build this company update on a pretty regular schedule. And if I'm sending you in April, May, June, July, August, you've now gotten to kind of see my company develop over 6 months, right? You've seen our progress. You've seen the product unfold. Maybe you've seen us make a few key strategic hires or bring on some high profile advisors. You're seeing this thing take shape and kind of flower. And then in that August update, I put in a little thing. Hey, we're about to kick off our seed round. Do you want early access to our deck and data room? And I've seen deals that actually get picked up before they go out to market because the founders did that prep work of, kind of nurturing relationships along the way for 6 months using company updates. So long-winded way of saying, in addition to having your deck, your data room, having a regular company update that you send out monthly can be a great marketing tool, right? It's just like marketing complements sales, this is a way to market your company before going out to raise capital.
I really like that. And I don't see why more startups aren't doing that. And I really like it when in that update, they also have kind of what their wants are. They say their accomplishments, what they've done. And also we're looking for another advisor with this background, or we're looking for intros to these strategics or that.
Yep.
And I mean, it's just a way to, you start getting curious and you start feeling like you're a part of this startup if you help them out and you get that relationship.
Absolutely. And I want to riff on that for a minute, because I think that's brilliant. Not only do you send this update to potential investors that you want to kind of come along on your journey, and maybe they are interested in what you're doing and they are making an intro to an advisor or a chief marketing person even before they've written you a check. Like, that's great, right? Think about the investor that's actually added value before they've even written you a check. That goes a long way. But also thinking about it, like, who else could be helping you with this business? It could be other advisors, other founders, right? I'm on the receiving end of a lot of company updates from our customers just because I've got to know them. Doesn't mean I'm helping all of them, but sometimes I'll see that ask for help. I'm like, oh yeah, I totally know someone at XYZ. Happy to intro them. Wouldn't have known that if I didn't read about it in the update. So kind of thinking where I'm going with this is thinking about like more broadly, not only using the updates as a way to nurture and pre-market your deal to investors, but to also just engage like a larger stakeholder base and fan base. And it's so powerful. And last thing I'll say about this, like, if you have a little ask for help in your update, I'm looking for a key advisor who really knows, e-commerce transaction systems, whatever it may be, something specific, and someone makes that intro, it ends up, leading to a hire or something like that. In your next month's update, thank that person. Call them out. Like, thank you so much to Sean for making a key intro to Rashida, who's our new, chief commerce officer, right? Something like that. And now you as the person who got the update, took some action, and now get the next update, you're a star, right? You feel not only did you help, but you're being called out and thanked publicly. And this update list, some of them can be out to thousands of people, right? Like, that's huge. That's huge. So,
oh yeah, I love that. Now you're like, your tribe is formed.
Yeah, right. I like that. The tribe. Yeah.
So Nathan, one last question, and thank you for all the time you've given us and all the wisdom you shared through your experience. Even back investment banking to now, is there any last either tidbit, story, wisdom, anything you'd like to share with our audience before we wrap it up?
Yeah, I think, raising capital can be pretty intimidating to founders, right? Maybe you're 3 years out of college, you're an engineer. It's like, how the hell do I go pitch all these money people, down on Sand Hill Road? How do I crack into Silicon Valley? I'd say, like, don't ever think it, just start doing it. Just start doing everything we just described here. Getting a good story together, right? Because stories are really what people are investing in, right? Especially in the early stages, investors are investing in a story. What is the story this founder is telling me? And do I believe it? And is it a big vision I can get excited about, right? So start to get your story together. Start to do the research. And this is going to take time, like we talked about. It's a step a lot of people skip or shortchange. Start to do the research in building that target list of investors. Start that process way in advance of when you plan to raise money, because it can take. When I was doing this for companies as a consultant, I would say it would take me 50 to 100 hours of research to build a really high quality target investor list. So start that process early, and then start the investor update outreach, the permission email, and the company update thing early. You do those things. Good pitch, good story, well qualified list, and start to nurture those relationships with a monthly company update. Your fundraising is going to be easy. If your company's cool, right? You still have to have a cool company, but your fundraising is going to go much faster than if you don't do that stuff and yeah. So,
and with that, Nathan, if anyone wants to find out more information about you, your company, what you're working on, what's the best way to go about doing it?
Sure. So Foundersuite is the business, FounderSuite.com. Pretty easy to find. And then we are simply at Foundersuite on, Twitter, Facebook, LinkedIn. I'd love to connect on LinkedIn, maybe mention, that you heard about me on the show. It's simply
the Silicon Valley Podcast.
Of course, the Silicon Valley Podcast, which is awesome. And I think it's LinkedIn.com/in/Nathan Beckord, right? So easy to find, but may mention you saw me on Sean's show, Silicon Valley Podcast, awesome show. And we put out a lot of good content on LinkedIn. So I'd say check that out. And then last but not least, we do have our own podcast called How I Raised It. It's simply interviews with like 200 founders on how they raise capital, just getting into the weeds of like, how did they work the angel network circuit, or how did they, use LinkedIn to find leads? I mean, it's very tactical, granular stuff. So that's good. And hopefully we'll get you on our show and we can, get some tips from your brain for our founders. So How I Raised It on YouTube, SoundCloud, iTunes, Spotify, all the usuals.
Fantastic. We'll have all that information in the show notes. And with that, for the audience, I know you're going to listen to this episode multiple times. While listening, please share with your network. Also go on iTunes and any other podcast platform. Give us a good review. It encourages us to create more content like this. And for everyone out there, please connect with me on LinkedIn. It's just Sean Flynn, and all my social media handles are Sean Flynn SV. It's ShawnFlynn. If anyone is looking for a mid-market investment banker, please contact me. I'm always open to have a conversation. So if you're looking to acquire a company, if you're looking to sell your company, raising growth capital or secondaries, please reach out. I'm a principal at a mid-market investment bank. And with that, Nathan, I want to thank you one more time for taking the time today to be a guest on the Silicon Valley Podcast.
Thank you, Sean. Much appreciated.